It's 11 p.m. You're scrolling listings, and every house that isn't visibly falling apart is $500,000. Popcorn ceilings. A bathroom that hasn't been touched since disco was popular. A cozy yard that's really just a strip of dirt. And somehow it's labeled a starter home. You start wondering if you missed a memo, some secret raise everyone else got. You didn't. It's not you. It's the math. And the math, honestly, is brutal. I'm Nick, and today we're doing something realtors won't love, figuring out who can actually afford a $500,000 house in 2026. Not who a bank will approve, but who can buy one without turning their life into a constant low-grade financial panic. Because approved for a loan and can actually afford it are two very different sentences. Let's start with where we are. In a huge number of U.S. markets, $500,000 isn't a nice house anymore. It's the baseline. That gets you a modest 3-bed, 2-bath box, nothing extravagant. Median household income in the U.S. sits somewhere around the mid-80,000s. So we're asking typical earners to buy homes costing roughly 6 times their annual income. A generation ago, that ratio was closer to 3. If that gap feels absurd, that's because it is. Start with the down payment, because this is where most plans die quietly. The traditional 20% on a $500,000 house is $100,000 in cash. The average American has a small fraction of that sitting in savings. So you're not slightly behind, you're tens of thousands of dollars behind. And saving your way there is brutal too. Even saving a disciplined 10% of an $84,000 salary gets you there in over a decade, assuming prices don't rise in the meantime, which they always do. So most people put down less, 5% or 10%, and unlock a new monthly guest, PMI, private mortgage insurance. This is a fee, often $200, $400 a month, that protects the bank, not you, in case you default. It's essentially a tax for not being wealthy enough to hit 20%. Now the mortgage itself. Say you scrape together 10% down, $50,000, leaving a $450,000 loan. At today's rates, roughly 6 to 7%, your principal and interest payment alone lands around $2,800, $2,900 a month. And that's before anything else. Add property taxes, commonly $4,000, $8,000 a year depending on location, roughly $500 a month. Add homeowner's insurance, which has climbed sharply thanks to more frequent extreme weather, another $250, $350 a month. Add maintenance, the line item nobody budgets for until the water heater dies at midnight. The standard rule is about 1% of home value annually, which on a $500K house is roughly $400 a month. Then tack the PMI back on, another $200, $300. Add it all up, mortgage, taxes, insurance, maintenance, PMI, you're looking at roughly $4,300, $4,400 a month in total housing cost. And that's the good scenario where nothing breaks and the HOA doesn't surprise you with a special assessment. Financial guidelines generally say housing shouldn't exceed 28% of gross income. Banks will often approve up to 43% total debt to income. Reverse engineer that $4,350 payment against the 28% guideline, and you'd need to earn roughly $185,000 a year to comfortably carry it. Even under the looser 43% bank standard, you're still looking at close to $150,000. And only a small share of U.S. households, somewhere around 15 to 20%, actually earn that much. Meaning the overwhelming majority of American households cannot comfortably afford a $500,000 home under any responsible standard. Not an opinion, just arithmetic. So who's buying them? Some are dual high earners. Some have family help. And a lot are simply stretched to the edge, one emergency away from real trouble. Let's actually run this on a real household. Meet a couple earning a combined $160,000, well above median, solidly upper middle class on paper. Should be comfortable, right? After federal and state taxes, FICA, and a modest 401k contribution, their real take-home lands around $9,400 a month. Subtract the roughly $4,350 housing cost, and they're left with about $5,050 for everything else. 2 commuter car payments, $750. Insurance on both vehicles, $250. Gas, $300. Student loans that funded the careers that qualified them for this mortgage in the first place, $600. Health insurance premiums their employer doesn't fully cover, $400. Groceries for a family trying to eat reasonably well, $800. Utilities for the bigger house, $450. Running total remaining, around $1,500. And that's before clothing, kids' activities, car repairs, medical co-pays, entertainment, or actual savings and retirement beyond the minimum. This household is spending nearly half their take-home pay on housing, not the recommended 28%, closer to 45%. And they're not reckless people blowing money on luxuries. They're just living in a house the market insists is normal. Here's what that actually feels like day to day. Checking your account balance before buying groceries. Saying no to a $35 school field trip because the check engine light might mean $500 you don't have. Lying awake doing math about tires versus rent. One unexpected bill, an AC repair, a fender bender, a dental emergency, and it goes straight on a credit card because there's no cushion left. And that's the math for a household earning $160,000. Now picture it at $120,000, or $100,000, or the actual median around $84,000. At that level, a $500K house isn't tight. It's simply not mathematically possible without either major outside help or taking on a level of risk that would make most people nervous. Here's the uncomfortable part. Nobody in the transaction is incentivized to tell you any of this. Sellers price based on comparable sales. Banks approve based on technical qualification, not your quality of life. Agents get paid when the deal closes, not when you make a wise decision. The system is built to get you into the house, not to make sure you can actually live in it without drowning. And once you're in, you're locked in. Walking away 6 months later isn't simple. It tanks your credit and burns your down payment. So people stay. They stay in homes stretching them thin, in jobs they're afraid to leave, quietly watching savings never materialize, wondering why achieving the American dream feels this stressful. Home prices have climbed roughly 400% since 1990. Median income has grown maybe half that. The ratio has broken, and pretending otherwise doesn't fix it. You can't budget your way out of a structural affordability gap. You can't side hustle your way to a $100K down payment while rent already eats half your paycheck. So here's the permission slip nobody gives you. You're allowed to not play this game. You can look at that $500K listing, run the real numbers, and decide it's not worth trading your financial stability and mental health for it. Keep renting. Save aggressively and wait. Look at smaller homes or different markets. None of that is failure. It's just math, taken seriously. Because real wealth isn't a house that owns you back. It's margin in your budget. It's being able to invest consistently instead of white-knuckling every payment. It's sleeping through the night without doing rent math in your head. The industry profits either way. The bank on your 30-year loan, the agent on the sale, the insurer on your policy. Nobody in that chain profits when you say, "This doesn't work for me right now." So if you're feeling priced out, understand this clearly. It's not a personal failure. It's a system where prices simply outran wages. Run your actual numbers, be honest about your income, and if it doesn't work, walk away. There's no trophy for being house poor. The real win is a decision built on math, not pressure.